All right, today we're putting a global giant under the microscope, Pfizer. We're going to do a full financial health checkup. And by digging into their latest quarterly report, we're going to see what's really going on behind those massive billion-dollar numbers.
So, have you ever wondered how you can tell what a corporate giant is really thinking? I mean, forget the glossy press releases and the slick TV ads for a second. Where do you find the real story? The unvarnished truth about their strategy, their worries, and their actual vision for the future? Well, you go right to the source. You look at the documents they legally have to file with regulators. And for us today, that means we are cracking open Pfizer's Form 10Q for the third quarter of 2025. You can think of this as the blueprint for everything we're about to talk about. Okay, so for any health check, you got to start with the vitals, right? We're looking at the most basic, high-level numbers first, just to get a feel for the company's overall condition. And boom, right off the bat, something interesting jumps out. Total revenue for this quarter was about $16.7 billion. Now that's obviously a mind-boggling amount of money. But here's the kicker. It's actually down from $17.7 billion in the same quarter last year. So that gives us our central question, doesn't it? Why the billion-dollar drop? To find the answer, we have to look beyond that one big headline number and really see what's happening under the hood.
And that, of course, brings us to the company's engine, its products. You know, a drop in revenue isn't just a number on a spreadsheet. It tells a story. It's a story about what people are buying and what they're not buying anymore. And for Pfizer, that story is a big one. It's all about this massive transition in a post-COVID world.
The data from the 10Q really tells the whole story. On one hand, you've got the COVID-era blockbusters, Paxlovid and the Comirnaty vaccine, and you can see their revenues saw pretty significant declines. But then, you look at the other side of the ledger. Their blood thinner, Eliquis, and their heart disease drug, Vyndaqel, both saw some really strong growth. So this clearly illustrates the dynamic at play. Pfizer is smack in the middle of a huge pivot. The once dominant COVID products, we can call them the fading stars, are naturally declining as the world moves on, while a new portfolio of rising stars is growing rapidly to take their place. This exact shift is the primary reason for that top-line revenue change we saw earlier. Okay, so if the present is all about this product transition, what's the treatment plan for the future? How does a company like Pfizer make sure it has the next generation of rising stars? Well, the answer lies in its research and development investments. And if you want to understand just how big their bet on the future is, just look at this number. In this quarter alone, Pfizer recorded a charge of $1.35 billion. And no, that is not a typo. That's for a single R&D deal. So what on earth was that massive charge for? It was for what's called an in-licensing agreement with a company called 3S Bio. In simple terms, Pfizer is paying for the right to develop and sell a promising cancer therapy that 3S Bio discovered. This is a core part of their strategy, using their deep pockets to buy access to the most promising science from all over the world. All right, now let's look at the other side of the equation. A health check isn't just about growth, it's also about efficiency. And while Pfizer is spending big on future drugs, it's also putting itself on a strict multi-billion-dollar diet to manage its current costs. And they are not being subtle about it. This is a direct quote from the 10Q report. They've launched a massive company-wide program to basically get their spending in line with what they expect to earn in a post-COVID world. So, how are they doing it? This diet has two main components. First, there's a general cost-based program, and just implementing that is expected to cost $5.3 billion. It targets everything from sales to admin. Second, there's a manufacturing optimization program costing another $1.4 billion. Together, that is a nearly $7 billion investment just to achieve long-term savings. But what's really fascinating here is how they're cutting these costs. The report explicitly states they're using enhanced digital enablement, including automation and AI, to get leaner. So this isn't just about old-school budget cuts, it's a high-tech overhaul to build a more efficient company for the future. Now, no health check would be complete without talking about the risks. The 10Q isn't just a highlight reel, you know? It's also where they have to be frank and disclose the challenges and potential headwinds the company is facing. And one of the most significant risks outlined in the report is ongoing litigation. Pfizer is juggling multiple major legal battles over a whole range of products, from Zantac to Chantix. Each one of these represents a potential financial and reputational liability that the company is going to have to carefully manage for years to come. So what have we learned from this health check? Well, Pfizer is a company in a profound state of transition. It's managing the decline of its COVID behemoths, fostering the growth of new drugs, investing billions in future science, and aggressively cutting costs. A financial report like this is just a snapshot in time, but it tells a really dynamic story. And it leaves us with a big question. What story will the next one tell?